What if I told you that the greatest economic collapse in modern history, the Great Depression, can be traced back to the decisions of just one man? A man who wasn't a tyrant, not a criminal mastermind, not a corrupt banker, but a quiet, soft-spoken economist who genuinely believed he was saving the country. What if the crash that destroyed millions of lives, wiped out fortunes overnight, and reshaped the entire global financial system, began with a single warning, a single policy shift, a single miscalculation? And what if everything we're seeing in the world today, the bubbles, the panic, the interest rate shocks, is following the same pattern again? This is the story of Andrew Mellon, and the story of how one man's philosophy, one man's voice, and one man's decisions helped ignite the worst economic disaster the world had ever seen. Stay with me. To understand how one man could influence a global disaster, we first need to step back into the 1920s, an age people remember as the Roaring Twenties. America had emerged victorious from World War I. Factories were booming. Technological innovations like automobiles, radios, washing machines, and electric lighting were becoming part of everyday life. A wave of optimism swept over the country, and for the first time, the average person believed they could become wealthy through the stock market. The stock market wasn't just rising, it was exploding. Ordinary people were borrowing money to buy shares. Banks were encouraging it. Newspapers celebrated it. Politicians praised it. That optimism blinded everyone to the enormous risks building underneath the surface. Behind the scenes, the entire economy was balancing on cheap loans, dangerous speculation, and a Federal Reserve desperately trying to maintain control. And in the middle of it all was one man, a billionaire industrialist turned Treasury Secretary, Andrew Mellon. Mellon wasn't loud. He wasn't a showman. He was a disciplined, cold, analytical thinker who believed in strict economic laws. To him, markets corrected themselves. Recessions were healthy. Government interference made things worse, and speculation, even when dangerous, would eventually punish itself. The tragedy is that Mellon wasn't trying to destroy the system, he thought he was saving it. Andrew Mellon took office in 1921 with a clear mission: cut taxes, shrink government, and keep money sound. He believed that low taxes for businesses would boost investment, and for a while it worked. The economy grew, the national debt shrank, confidence exploded, and investors poured into the market like never before. But the success created a new problem. Speculation turned into an addiction. By the mid-1920s, margin trading and borrowing money to buy stocks was out of control. A person could put down $10 and buy $100 worth of stock. Brokers loved it. Banks fueled it. People who had no financial background were gambling their life savings on rumors and hearsay. Mellon saw the danger, but he refused to interfere directly. Regulation wasn't his style. He believed the market would self-correct, but the market didn't correct itself. It inflated further. It reached heights no one imagined. By 1928, the system was fragile, overstretched, and dangerously dependent on borrowed money. And Mellon, without realizing it, was about to pull the wrong lever at the worst possible time. Early in 1929, Mellon finally grew worried about the madness on Wall Street. So he pushed the Federal Reserve to raise interest rates, sharply. He believed higher borrowing costs would cool down speculation, but he didn't foresee the chain reaction it would trigger. Higher interest rates began squeezing banks. Borrowers struggled, investors hesitated, credit tightened, and the very system fueling the boom began to dry up. Instead of a gentle slowdown, the market started trembling. Then came the final spark. In mid-1929, Mellon made a public comment warning that the stock market was dangerously inflated. Those two words, dangerously inflated, hit the market like a bomb. Investors panicked. Newspapers spread fear. Brokers demanded loan repayments. As selling increased, the bubble that had taken years to build began collapsing in days. By late October 1929, panic took over completely. On October 24th, Black Thursday, the crash began. Crowds gathered outside the New York Stock Exchange. People screamed, phones jammed, banks pleaded for calm. But nothing stopped the fall. The bubble burst. But the crash, bad as it was, wasn't the real disaster. The true catastrophe happened after. The breaking point. When Mellon's cure became a poison. The stock market crash could have been just a severe recession, but Mellon's next decision turned it into the Great Depression. Mellon advised President Hoover to let everything collapse naturally. His infamous recommendation was to liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. In his mind, the crash was a cleansing fire that would remove the rottenness in the system. He believed lower wages, lower prices, and bankruptcies were simply part of restoring balance. But in reality, liquidation wasn't cleansing the system. It was killing it. When businesses collapsed, people lost jobs. When people lost jobs, they stopped spending. When they stopped spending, companies lost revenue and fired more workers. Banks failed, wiping out the savings of millions. Families were ruined. Entire industries collapsed. International trade froze. Countries like Germany and Britain were dragged into the chaos. What Mellon saw as natural correction was actually a downward spiral with no bottom. His refusal to support government intervention made the crash deeper, harder, and longer. By the time Hoover realized Mellon's ideas were damaging the country, it was too late. By 1930, tens of thousands of businesses had failed. By 1931, banks were collapsing every week. By 1932, unemployment reached 25%. In some cities, it hit 50%. People lined up for bread. Homeless camps, called Hoovervilles, grew in every major city. Farmers lost land, families split apart. In New York alone, 20,000 children were abandoned because parents could no longer feed them. Globally, the collapse spread like a contagion. Europe's banks fell, South America's exports died, Asia's economies seized up. Historians still debate how much of this Mellon caused. He wasn't the only factor. But his decisions amplified the crash dramatically. His philosophy dug the hole deeper. His refusal to intervene prolonged the suffering. One man didn't cause the Great Depression alone, but one man greatly accelerated it. President Hoover, trusting Mellon, initially refused large-scale intervention. He tried voluntary agreements, small public works projects, and optimistic speeches. None matched the scale of the disaster. By 1931, Hoover quietly pushed Mellon aside. By 1932, Franklin Roosevelt won the presidency by promising the opposite of Mellon's philosophy: government action, spending, banking reform, and safety nets. The New Deal reversed Mellon's ideas, but the damage was already done. Modern parallels. History is repeating now for the uncomfortable part. The same patterns are happening today. Cheap borrowing, bubbles in stocks, crypto, real estate, AI, speculation by inexperienced investors, overconfidence in central banks, warnings ignored until too late. In 2008, Alan Greenspan's low interest rates helped inflate the housing bubble. In 2020, 2021, massive stimulus and near zero rates inflated multiple asset bubbles. In 2022-2023, a sudden rise in interest rates shook the global economy, just like in 1929. Once again, the world is one decision away from disaster. History doesn't repeat, but it rhymes. 1. Economic disasters often begin with good intentions. Mellon didn't want a depression, but his beliefs blinded him to reality. 2. A single influential leader can shape the entire world economy. In 1929, it was Mellon. Today, it might be a central banker, a tech billionaire, or a finance minister. 3. Ignoring bubbles is just as dangerous as creating them. The warning signs were there, but no one acted until it was too late. If you think a collapse like 1929 can't happen again, remember that the people in 1929 were absolutely certain it couldn't happen either. The global system is fragile, over-leveraged, dependent on confidence, and confidence can vanish in a single moment, sometimes because of a single person. If you want more deep dive stories about economic history, hidden financial mechanics, and the patterns shaping our world, make sure you subscribe, hit the bell icon, and share this video. The more you understand history, the better prepared you become for the future. Because history isn't just something we study, it's something we're living all over again.